Okay, our next speaker needs no introduction. Where is Toby? Here he comes. Toby, please welcome, Chair of IMAP and Director of Philo Capital Partners. We're going to get Michael Karagianis up and I think James Trude to speak a lot about the sustainable high net worth client offer, what it looks like and how we do it all. So, Toby, over to you.
Thanks very much, Mike. And thanks very much, Mike, for the mic, Mike. Look, we're actually going to pick up on one of the points that Manny started to speak about, which is the importance of high net worth. And I'm delighted to be joined on the stage by James Trude, who's the Chief Client Officer for Clime. Clime, of course, grew out of John Abernethy's business, or uses John Abernethy's business, which is one of the very original high net worth personal advice businesses, now part of Clime. And Michael Karagianis, who's Senior Consultant for JANA, who a business where high net worth genuinely means high net worth. So what we're going to do is spend a few minutes, James first and then with Michael, talking about their business and how they approach it, and then we'll have some discussion to draw those themes together. So James, over to you. Let me,
Thank you, Toby.
give you appreciate it.
Thank you. Good morning, everyone. So James Trude from Clime. My title's Chief Client Officer, but it's the reason for that title, which isn't always clear exactly what I do, is because I wear a couple of hats. One of my hats is leading the private wealth business within Clime. And so on this topic, in terms of thinking about building a sustainable high net wealth offer, I think it's one of the things we're going to touch on a lot today. A lot of the speakers are going to touch on is obviously the investment offer and the actual structure and the tools that we use, which obviously that Manny touched on previously. But I think one of the things that we think about in building a sustainable, answering that question, what is a sustainable high net wealth client offer, is I think some of the things around that as well. We know that the investment piece needs to reach certain hurdles around cost, around transparency, around delivering the investment goals it sets out to achieve. But in terms of the client offer, I think it's important to think about that more broadly and set back as a bigger picture. So starting thinking off the problem, which with all problems there's also obviously opportunities, and I think you're probably going to see everyone quote slightly different stats across this opportunity of that intergenerational wealth transfer. Whichever stats you see from many different reports, they're large numbers. The ones we've got there, 2.5 trillion by 2050 transferred to that next generation. That's 70% of the assets in that high net wealth market. So there's a lot to play there. And what that probably means is you'll see a lot of the players, some be very successful in doing that, and they'll probably accelerate into that market, and others, who may struggle with that may end up falling behind in that market. But there will be some big moves as that money moves in terms of who benefits and who doesn't. But the opportunity, when you delve into it, while intergenerational engagement seems the obvious answer, there are some challenges in there as well. The first one is the cost of living pressures that we all feel in our day-to-day mean that cost of living, that transfer of wealth is happening even faster. We've got children taking that money, paying down their mortgage, asking for that money earlier while the parents or grandparents are still around. And so it's moving faster but getting spent. So the money may not necessarily all be there to be able to manage in the same way that maybe it was done for the parents or grandparents. And then also, we've seen some of the stats on, how much the money sticks around with the same advisor. They're very low numbers. The numbers we see, 6% of the children still use the same advisor, and that 47% decide that they can do it themselves. So maybe that relationship might not even be there to win. So there are some challenges with that, opportunities, but challenges in how you do it. So one of the things in talking to our high net wealth advisors that have been successful over the years in capturing and maintaining the sustainability of those assets starts with building trust, but not just with the clients, those that have built the wealth, but also across the generations. So, the children and even the grandchildren, but thinking about that very much as a family unit. Obviously, you need to have that expertise. You need to have, and that's both internal and external. So the person who's maybe the relationship manager and owning that family relationship doesn't need to be able to solve every problem. They may have others within the team who can bring different areas of expertise and experience, but also being able to tap into that personal, professional network to be able to bring in experts in maybe cross-border, tax expertise or something far more niche. But the ability to be perceived, to be able to have access to all of that skill set. Then one of the things that can be very valuable is being able to spend time with those clients to help clarify the bigger picture. One of the advisors that we work that from our team has engaged with one particular family group over 5 generations, which is pretty amazing. He's obviously an experienced individual in the marketplace, but to be able to have that touch point and be able to show that connectivity across those multiple generations really shows that it's much deeper than just a pure investment solution. And the ways that he talks about doing that is sitting down and going through an exercise like documenting family values, documenting how does that family connect and engage with each other, what's their family mission, and taking those values and being able to share them and educate them and help that leading generation who's maybe built the wealth take that down through their generations within their own family and understand what are their common goals and how can you contribute to achieving those. And that may be through education, it may be through philanthropy or broader goals beyond just the pure investment piece. And then the final one to continue that might be around the ability to revisit those values and continue to share those and check in. And so it might be something like when the family get together, what are their traditions? Is it at Christmas? Is there a winter holiday or something where they all come together and commit to that? And can they even put some time aside to revisit those values and ask, how have things changed for individuals in those families? Maybe it's changes in health, marriage, children, as families grow and split. And how do those values continue to be passed down? And really just broadening that engagement as far as possible, because that's really going to help facilitate and cement that sustainability across the generations. So obviously, in terms of the implementation of that advice, it's got to very much be strategic advice, but there are multiple inputs there from those, family values and traditions. Obviously there's structuring and tax implications. There's the reporting and access and transparency of those tools to understand, that they align with the goals of the family or the individual have set out. And then obviously balancing things like access, liquidity, etc. In terms of thinking it more from sort of, that retail versus high net wealth, what are the similarities, what are the differences? There's obviously going to be, consistency there across, maintaining returns ahead of inflation, managing risk, capital preservation, building that trust and making sure the client experience feels personalised and adjusted for the individual. But some of the differences are going to be that increased personalisation. So there is certainly a trade-off, as they talked about in the previous presentation, between sort of scale and personalisation. And as those clients get bigger, then that personalisation is really important. Now that can be a trade-off between actual customisation and the perception of customisation. So you can still use scalable tools within there. Within Clime Private Wealth, we leverage IMAs within our high net wealth clients because it allows that level of bespokeness, but still maintaining transparency and efficiency within the structure. So still leveraging the latest structures that are available. Things like liquidity become a really important, multi-generational planning we talked about, and just making sure that they align consistently. So how do we build a sustainable high net wealth offer? It's that strategic advice, considering that family mission, leveraging those flexible structures for the efficiency within our business, but still being able to create a bespoke outcome for the client. Mixing of those internal and external products, make sure you're partnering with best in class across asset classes in both public and private markets. But being able to differentiate through the support and the relationship. It's funny, if I look at the high net wealth advisors and those that are very successful, many of them have come from a retail world, a retail mindset, I guess, and they still bring that, going through that discovery process, trying to understand the individual, the holistic relationship, and what are their life goals, not just investment goals. And so understanding that problem first and spending the most time on the problem before actually jumping to the solution and not making assumptions about the individual, and working out how we can support around not just with an investment solution, but also around their broader goals and broader family mission. Hope that's helpful.
Thanks very much, James. And now it's my pleasure to ask Michael to talk a little about JANA and the way in which it attacks high net worth. And what Michael's going to give you now is a potted synopsis of the very in-depth discussion which I know we're going to have later on this afternoon in the masterclass. So over to you.
You're at pains to say don't steal the thunder from this afternoon, so I won't do that. Just a brief introduction to JANA. People may or may not know JANA, but we're probably Australia's largest investment consultant, about 1.4 trillion under advice. And people know us historically as being very strong in the institutional market. Possibly what they don't know so much is that over the last few years, we've migrated more into the non-super space. And so most of our clients are actually family offices, not-for-profits, endowments, education, and so on. So we, I guess, have an interesting perspective, because although we're dealing with some very large groups, we are actually moving right across this high net worth family office market and have, I think, a very good perspective as to what is required of that. And that just gives you some sense of our client base. But rather than really go through a presentation, I thought I'd actually just share with you some, I guess, learnings that we have in observing the family office high net worth market, and they are so profound. In fact, I've had to write them down to remember them. But I guess picking up on some of the themes previously, I mean, this is a market that is about 1.4 trillion according to Rainmaker in Australia. So it's really the second largest pot of money that sits behind, I guess, the industry fund retail supermarket. Spread across about 284,000 clients. Now, Rainmaker defines high net worth and family offices anything with $5 million of investable assets or above. One thing, if you are looking at moving into this space, and everyone's going to, I guess, come across a client that is in that bound, you know, maybe $5 million or thereabouts, but to actually pursue this space, I think you need to have a very clear definition as to which part of the market you're actually going after, because each one of those segments have different requirements. And to contrast, say, a client $5 million, they may in fact be, you know, very close to retail, just a little bit more wealthy. I mean, they're at the upper end of the mass affluent band. They don't have necessarily a lot of complexity there. And then you go to the other end of the scale where you might be dealing with a client that might have, you know, 50, 60, $100 million. We deal with clients that are 500 million and above, perhaps, and you've got a lot of complexity. So really understanding which segment you're actually after and what are the requirements of that segment. Understand what your capabilities are to bring to that segment. And if you feel that you don't have the full capability, that doesn't necessarily dissuade you. As James mentioned, in many cases with some of these larger high net worth clients, you're dealing with a group of other advisors. There might be specialist tax advisors, there might be specialist accountants involved in the process. There might be a lot of structuring involved that you don't necessarily, you know, have to drive yourself. Quite often with these clients, there's more than one advisor in the room, and in fact, there's more than one financial advisor. A case study that we've gone through recently where we worked with one of our advice businesses that we consult to, and they were approaching a family office, and they won that business with our help, about $80, $90 million. There's 5 different tax structures, effectively, corporate structures, trust structures, private ancillary fund, each of those with very different arrangements and requirements. And you don't have to be a specialist in all of those, but seek help. Bring in the specialists as and when you need it. And particularly if you're doing cross-border, it's not uncommon when you move into this ultra high net worth space, for example, family office space, that there are cross-border activities, investments, and that does indeed need specialist help. So I guess the point here is be aware of it, be aware of what you can bring to the table. Don't necessarily be put off by it, but be aware where you need to actually get some assistance in the process. High net worth clients themselves are very different. There is an old adage that if you've seen one family office, you've seen one family office. That applies to high net worth. I have seen ultra high net worth clients that are that because they won lotto. Basically, for all intents and purposes, they come from a very retail mindset. They just happen to have $40 million that lobbed. We've got other clients that have had a business event. They've transacted their business. They spent a lifetime building it up. They are extremely sharp and knowledgeable. They are also very possessive about their money and are probably struggling to trust someone to provide advice to them because they've never actually sought it before. So understand the background of the money and the fact that no two clients, even in the same strata in the high net worth space, are necessarily the same. Managed accounts can be very useful in this space. And this picks up the point that James made, and I think in the previous session, industrialisation or, basically mass efficiency against tailoring. Managed accounts do have a role, but it may be that rather than SMAs, you might be looking at MDAs or indeed taking that further, IMAs. We also work with private wealth businesses that specialise in the wholesale space that use SMAs as a core, but put satellites around that. And that, I think, is an important thing because clients in this space do not want investment solutions that any retail client can come in off the street and get. They want something special. And it may be that there is a core of, SMAs, for example, or indeed retail managed funds, but they want access to private equity, venture capital, direct infrastructure, direct property, and they're looking for you, if not to provide it, to at least provide gateway access to those that can provide it. Don't, and this is absolutely fundamental, probably the biggest error that we see, don't underestimate the complexity and the cost of servicing this client segment. We see a lot of advisors say, we really want to get into wholesale because, basically we can charge, 3 times, 4 times more than we can charge our average retail client. These are clients that want a platinum service, and that doesn't mean speaking to you once a year, getting an SOA from you once a year. They want to speak to you probably at least quarterly, and if something's happened overnight in the US or UK, they want to get on the phone to you. They want to be invited to special events. They want to get access to your IP, something above what the retail client segment that you're servicing is getting. You need to price it accordingly, and too often we see clients, advisors that we work with in the space, and indeed advisors that we come across that are just undercharging fundamentally for the amount of work we know is going to be involved in servicing that client. So I might leave it at that point.
Thanks very much, Michael and James. And just to the last point that Michael made, one of the things which we've been doing in IMAP lately is a study of the high net worth market, and that's resulted in a number of outcomes. We ran a webinar series recently, the masterclass later on today, which is part of this conference series, and a guide which we'll be publishing very shortly. Coming out of one of the conversations I had, as it happens, with one of the organisations that we spoke with, I was talking to the person I was talking to, and he said, we've got some of them coming in tomorrow. I'm just preparing for the presentation that Michael sort of touched on. I said, what is it? He said, look, we're bringing in 100 of our better clients from Sydney. They all pay us more than $100,000 each. So they had a $10 million fee stream plus in the room for lunch, so that in some ways identifies the sort of magnitude of the problem. So let's go back to the theme of today's conference, which is building a sustainable business model for advice. And what does it take to build a sustainable business model to target this part of the market? James?
I think it's, and it's been touched on a couple of times, that balance around efficiency and customisation. James from BlackRock talked about the mass personalisation. Technology and these products and the platform capabilities, are constantly improving, even just the last couple of years, and to the point that even SMAs, while they're obviously a retail product, there is customization available within that in terms of swapping out or excluding, and so there is an ability to have sort of mass mass personalisation there. And depending on your definition of high net wealth or mass affluent and which market you're looking to play in, I think they're starting to see that you can create a really high quality solution there for wealthy individuals that have some degree of complexity.
Well, and to that point, Michael, do you want to expand a little on managing that complexity of service?
Yeah. So just on that point, I think you could take it to the extent of saying, well, why not develop wholesale managed accounts? And I think that's a next evolutionary step where if you're servicing this market, you can put together a managed account comprised of largely wholesale products. Obviously, it's not going to be available to your retail segment, but it is very tailored to the wholesale requirements. And then you're really working with groups, fund managers, advisors that can actually support that proposition. It might work a little differently, but it actually, I think, is much more targeted for this space. But in terms of sustainability, I think what I'd suggest, rather than this being an accident that you just happen to stumble on high net worth clients, you've got to work out what your proposition is going to be in this space. How are you going to differentiate your proposition from your mass affluent retail clients? How are you going to go about sourcing these clients? Because this is a market that is, I think, very relationship driven. If you're going after the not-for-profit market, which is a very specific market in itself, and we know some advisors like that market, there is a very significant investment in front-end tendering processes that you have to get your head around. That's a very specialised field. Often you need support with that. But actually developing the relationships to get in front of high net worth, a lot of it is contacts. Do you join a couple of boards, perhaps on a pro bono basis? We see a lot of referrals coming to us through that type of mechanism where clients that we're engaged with, they might be superannuation funds, they might be not-for-profits, school bursaries, charities, for example, and they happen to have contact with high net worth clients and they provide referrals to us. That's a type of mechanism you've got to think about. And then your service proposition. How are you going to service this client segment as opposed to the retail client segment? What are you going to offer them that's over and above? And importantly, what your charging rate is, because if you think you've charged enough, I suspect that you're still well and truly underestimating it, and you need to probably do a bit of a cost-benefit analysis about what it's going to cost to actually service this segment.
So typically these clients will have, they come into the relationship with the advisor with a set of assets that aren't just $700,000 in a super fund, and so they bring in illiquid assets, they bring in stuff they've owned for a long time, they bring in things. How does the investment process accommodate the specificity of their circumstances?
And that's where we in our private wealth business use the IMAs, because there is that additional level of bespokeness available. So you can consider assets that are held, maybe it's a large single stock exposure through an employment arrangement they'd had or a business sale. Maybe it's private assets they have held in the family for a number of period of time. We can wrap that up and create that efficient reporting. And I think that's one of the things around efficiency is you want to make sure that you've got relationships and systems set up to be able to provide the reporting and the clarity and the transparency. But obviously that's got to start with a conversation around goals and purpose and what they're looking to achieve. But it's certainly a structure like an IMA, what we find actually allows us to bespoke and take on that individual level of complexity, but still have that level of transparency and flexibility.
And you, as an advisor, I think have to accept in this space that you are probably not going to be advising on the totality of the funds. There are going to be assets that the client will be self-directed on. It might be property. It might be, a portion of Australian equities that for whatever reason they've held for time immemorial, enormous capital gains associated with it. There might be, work-related assets, and they just can't be touched or administered. So they'll tend to ask you to advise around that. On top of that, I think I mentioned earlier that quite often there'll be more than one financial advisor in the room. A case study that we had with a group that we worked with that family office, that over a period of time, they had about, I think it was about 80, 90 million of wealth. They had developed relationships with 5 financial advisors. Each one of them had a different type of portfolio. Some were overlapping, but it had just built up by osmosis. And the group that we worked with had been brought in to try and do an audit, rationalise it, try and get everyone on a common reporting platform. And one of the biggest problems that groups have, family offices, ultra high net worth have, is they often have very poor reporting. So probably one of the biggest services you can actually provide them up front, apart from the strategic advice, which might come over a period of time, is to actually get them to get a handle on a consolidated reporting of their assets, get them onto a common platform if you can. That actually does an enormous service in terms of improving their knowledge of what their own assets are doing.
Now, are there questions for Michael or James? So, yep, one just over.
Enjoying the presentation so far, thank you. When you say IMA, I suspect a lot of us in the room are sort of going, what in the hell is an IMA? It sounds like a product, but there is no legal structure called an IMA. So what is it in your terms, in the way you're applying it?
It's an interesting question. It's a question that I asked other people that engage with IMAs in the market and struggle to get a consistent answer from people. But an IMA has an information memorandum, so it's a wholesale product. It allows the efficiency of being able to provide a wrapper as such to be able to see multiple assets and bring in bespoke and custom assets. But it can still be, we have multi-asset IMAs, so effectively a starting point, and that's where that kind of that efficiency benefit is able to come in. But what an IMA allows, for instance, that an SMA doesn't, is the ability to consider things such as a corporate action. Well, an SMA will consider that, say a buyback, for instance, participation in a buyback across the entire SMA pool. The IMA has the ability to consider it on an individual's basis, but still with that transparency, the ownership of the underlying securities.
So effectively a managed discretionary account for a wholesale client.
It's certainly a wholesale solution. Absolutely.
And so let's touch on this, because I was actually going to bring up the point about discretion and the willingness in this market for people to grant partial or substantial discretion. So what's your experience been about, the process to get to, trust us, we'll be making the decisions here?
Yeah, I think that varies. I mean, we talked about, this segment is not homogeneous. And so you'll have clients where they are willing to give you discretionary authority. It might be within an MDA context or an SMA, perhaps. There are other clients that are, that will only occur over a very long period as they gain confidence. So they might give you a small portion of their money, and then perhaps over time as the confidence builds up. And then there are others that will work purely on an advisory basis. And we see this with, very large family offices as well, because, in some cases you get to a point they might actually insource some of their own investment capability, where they might have an internal CIO, or they might have, a small team of investment professionals that are there really to, provide the conduit between the external advisors and the actual family themselves. So they're a standing, professional team, I guess. And they, will basically work with you as a sounding board, and you don't have full discretion, but you basically provide advice to them. They take it up to the board, and then, it gets implemented, depending on the response of the family office board.
Great. Other questions for just here. Oh.
Yeah, g'day. Can I ask what is possibly a stupid question, but I'm never afraid of those things. So you mentioned that they prefer to have, these high net worth prefer to have investments which aren't available necessarily to your standard retail investor. The assumption is they're looking for a better return, but I wanted to ask what typically is the driver, because sometimes that's ego, sometimes that's charitable reasons? What are the typical drivers for getting something different to the standard retail investor?
I think sometimes it's because they want something different. It's similar to someone turning up at Qantas and wanting the Platinum Lounge as opposed to the lounge I have to go to. So I think that's part of the rationale. I mean, I think that belittles, the concept that certain private assets can actually add genuine value. So from our point of view as an investment thesis, if clients can access direct property, direct infrastructure, direct private equity, venture capital, to us that is it's a superior investment outcome than either not being able to invest in it or going through a listed entity that provides you an extra layering of costs. So, for our clients, almost invariably where they can get access to it, we do facilitate that and we do recommend it. These clients, they expect to be able to get access to the same sort of strategies. I will say one of the pitfalls in this area is that there's probably a lack of quality advice because it's not as well researched. It's a bit of a gold rush. And so you see a lot of private equity deals come to market targeting this particular sector. Fund managers have really focused in the last couple of years on the opportunity that's presented by the family office and ultra high net worth sector in Australia, because we see the superannuation sector is rationalising, and there is enormous variation in the quality of products that are coming to market, and a lot of clients in this space need good advice to ensure that they avoid the pitfalls of investing here as much as identify the real standout opportunities.
Well, one of the people in the study which we've been doing on high net worth, one of the other comments I remember from that is, they all think they can deal with illiquidity until they're across the table from the lawyer of their soon-to-be ex-wife.
That's a rather cynical. From private assets, no, definitely, and it's compelling. Not only are the returns superior, but of course the volatility is less pronounced. Now, we could spend a whole separate session on that particular point, but that's been our long-term thesis, and that's why you see groups like the largest superannuation funds in Australia and endowment funds that actively invest in these areas because they don't need the liquidity and they can capture an illiquidity premium from it.
The only thing you'd add to that is certainly, it's a balance, I think, of ego and access. I think you're allowed to say that. But because in the wholesale space there are less frameworks, less controls, it's easier for players to come into that market. You see a lot of these opportunities come into market, and therefore you have to have a very strong framework of due diligence to be able to screen those, and that becomes part of your responsibility. For ourselves, we have part of the group also a dealer group, Madison Financial Group, which mostly retail. There are some wholesale work in there as well, but we get to leverage some of the due diligence frameworks within that we have a retail APL. We also have a separate wholesale APL, but those controls are very important in that wholesale space.
One last question, yes.
Thank you for that. Great discussion, and you touched on charging ultra high net worth clients and family offices, and I just wanted to get your perspective on what maybe you may consider best practice or common practice. From what you're saying, it sounds like advising those types of clients is more of a mindset than a process, because each relationship is different. And you might have $300 million clients, family groups. One is just pure $100 million, across that you're advising on completely in a managed account, for example. One tax structure might have another family where $50 million is within an illiquid asset from an exit, and another family which has a PAF, trust, companies, multi-generational, multi-jurisdictional issues. So advising, charging the same fee wouldn't be practical.
No, and I think you've got to get a good sense of that up front. We spend a lot of time with our clients actually understanding the nuances before we actually provide any quoting on it, because it can vary. I would say to you that majority you'll find are probably in the latter experience that you gave, where there's generally more complexity than less complexity. You will probably get a portion of the assets. So if it's a $500 million family office, you're not going to be advising. We're not going to be advising on that, most likely. There'll probably be more than one advisor in the mix. You might get one particular entity, but I suspect that you'll probably get 2 or 3 entities across that. You've also got multiple stakeholders that you've got to be mindful of. I mean, sometimes it's a bit like sitting through a season of Succession. It can be quite problematic, and you've got to take that into account because different stakeholders, different generations have very different requirements, and you've got to sort of manage through that process as well. So all I'd say to you is, you know, it's not likely to be 2 or 3 times what you charge a retail client. Private wealth groups, you know, generally are charging in the hundreds of thousands for these types of clients. Now, they do bring a lot of services. You know, that's a sort of price point we would work at. You know, you bring a lot of capability and expertise. It might not be what you want to go head to head with. So there might be a middle ground there where you're focusing on, where, you know, maybe you're looking at high net worth up to 100 mil or thereabouts. I mean, it's 284,000 clients. We're probably only focusing ourselves on the top 150. That leaves, a good 282,500 to focus on.
And in fact, so to wrap up, there is in fact a part of the discussion for Findex later in after the break actually focuses on pricing strategies. There's some good detailed discussion on that. So please join with me in thanking Michael and James for a very interesting.